Welcome everyone, another episode of Financial 15, specifically on our series on saving tax in retirement. We've done a number of videos on this topic. We're doing another one in that series today. Today, we are going to be talking about prescribed annuities. We'll get into the details. You want to stick around.
Yeah, this is episode 4 in our series on saving taxes in retirement. It is one of the most popular questions we've ever had from people. How do we do it? What do we want to do? If you want to see the other 3, whether they be in regards to RRSP Meltdown or if you're looking for pension splitting, they are all at our website, beckerorr.com, or you can go to our YouTube channel or like us on Facebook. We always like all of those. But enough with me going on to this. We are getting into prescribed annuities today, Clint. You are going to describe that to us. But before we start, what are the 3 Ds of tax planning that we've got to stress to everyone?
We've gone through this before, but it's important. It helps conceptualize the idea, how we're saving tax, what bucket does it fall into. This is important not just for tax saving strategies in retirement, but tax saving strategies in general. You have that deduct column on the left. So if you're getting a tax credit, a tax deduction, that would be the deduct strategy. Divide, we talked about that when we talked about pension splitting, dividing the income over 2 individuals. You can also divide the income over calendar years, another way to use that divide strategy to lower the income. And then prescribed annuities fall into that defer bucket. We're pushing the tax burden down the road. We're deferring it, and that allows us to save some money. So that's the category we're going to focus on today. But before we get too far into the prescribed annuity, we need to ask the general question here, Kevin. What is an annuity? I'll throw that to you. What is an annuity?
Yeah, that's the biggest thing to figure out first. The annuities come in a variety of different options and different strategies, but before we get to the prescribed annuity, you need to know what an annuity is. And basically, in simple layman's terms, it is a guaranteed series of payments that you receive from an insurance company in exchange for a lump sum of cash. So let's say you have $500,000, you give it to the insurance company. They are going to give you same amount of payments each and every month or each and every year, whatever the case may be. They are guaranteeing these series of payments to you, and they will do that most of the time for the rest of your life. And that's part of what's going on with the annuity. So it's important to know that what an annuity is, but there's also more differences when we get to the prescribed annuity, isn't there?
Absolutely. There's so many bells and whistles when it comes to annuity, but the basic concept here with annuity, you've got a lump of cash, you give that to the insurance company guarantees you a series of payments. Now, one specific type of annuity is a prescribed annuity, and that's what we're talking about here today. So we'll get into that specific type of annuity. The prescribed annuity has to do with non-registered funds. So that lump of cash you give the insurance company is non-registered money. It's not an RRSP. It's not a TFSA, not part of some pension program, non-registered funds, and it gets special tax treatment. So how does it work? It's a tax deferral. Like I said at the outset, it's that deferral strategy. So you get taxed on the income the year in which you receive it, but only a portion of that payment is taxable. So let's say you get $1,000 a month out of your annuity. Well, not the full $1,000 is going to be taxable. It'll be a blend of interest and principal, so only part of it is going to be taxable, and they'll level out the after-tax income. So you end up with a level tax burden throughout your life, throughout the course of this annuity. So you're deferring the annuity, and you're also leveling the income, which can help lower the tax burden in any given year. So you have some benefits there in terms of how it works, but there's a couple other benefits as well. Leveling the income, deferring the income, that can help out, Kevin, because that can keep you below some thresholds when it comes to income-tested benefits.
Yeah, I mean, and that's a very important part. And again, remember, one of the big points that you mentioned right up top was this is non-registered money that we're dealing with for that special tax treatment. Most annuities come from registered plans to be able to deal with it. This one's not. And that's why we can get some of these tax advantages. And as you mentioned before, it helps with the income-tested benefits. In specific, the one we really like to deal with on this is OAS. And we do have videos describing OAS and the clawbacks and everything. But if you make too much money, all of a sudden, they're going to start to claw back your OAS over a certain amount. To try and avoid that, an annuity is a way to deal with it, because some of the income you're getting out of that is not full income. Some of it's going to be interest, some of it's going to be your principal. So that can keep you under your income tested benefits that you get from the government. Now, it's not strictly OAS. There are other ones out there, but that's the most popular one that people seem to relate to when we start dealing with this. But there's more than that, isn't there?
Yeah, there's a couple of other benefits here. So the idea being we level out the income, enough for the payment is not fully taxable, only partially taxable. So that helps lower the income. That helps with the income tested benefits. And also prescribed annuities qualify as pension income. We did another video on pension splitting. We talked about what qualifies, what doesn't qualify.
Yes.
After the age of 65, prescribed annuities qualify as pension income, which means they can be split. Now, for non-registered money, there's only so many ways you can split it. In fact, there's very few that can allow it to qualify for pension splitting. So RSPs after the age of 65, you convert it to a RIF. You can now qualify any withdrawals from that account as pension income. You can split it with your spouse. You really can't do that with non-registered funds, but through a prescribed annuity, you gain access to that benefit. So that can be a big tax savings right there, the ability to split the income that comes out of the annuity. Also, you can qualify for the pension income tax credit. It's a $2,000 non-refundable tax credit. You split the income, you have some, now your spouse has some pension income, you can both qualify for that credit. So you can see how we're mixing and matching the strategies here. That pension splitting is a divide strategy, the tax credit would be a deduct strategy, and the whole thrust here started with a prescribed annuity, which is a defer strategy. So you're stacking them on top of yourself here, Kevin. You're getting so many tax savings from all the different benefits.
Yeah, and the other factor we're actually combining a strategy you get on a non-registered side with strategies you get usually only from the registered side, the pension income splitting. Theoretically, we can't do that any other way. So these are all positives that I think that have to be looked at going forward with what we're dealing with in savings tax for retirement on both non-registered and registered savings.
Yeah, lots of perks there, but we have to kind of qualify. This isn't for everybody. Not everyone should rush out to get a prescribed annuity. Really, it's suited for a particular type of individual, at least in our opinion. So who is this best suited for, Kevin?
Yeah, as we can mention, this is basically suited more or less for the conservative individual, the person who likes the GICs or the bonds, that doesn't really want to get involved in the market. They don't mind that they're not getting as much in interest possibly. They just know that there's safety and there's security there. And those are important features that they need to deal with. And again, this is based on a surplus of non-registered assets. So we're not asking you to take all your savings and putting it into this thing, but let's assume somebody's sitting on $750,000 in cash. You take 500 of that you don't need or you don't think you're going to need. This is a perfect strategy for the conservative person looking for tax efficient income going forwards. Again, we must remember that annuity rates are similar to what you're going to get on interest rates on GICs. Now, they tend to be slightly better. So, if you get 2% on a 5-year GIC, maybe you're getting 2.5% on that annuity that's going on. So they are low rates, at least presently they are. But again, this is something that you have to know. It is for a conservative person. It is for excess capital that you have in the non-registered side. And you do want it so that you can maintain that tax efficient income going forward. So that's the theoretical perfect client for this type of investment.
Yeah, and we should mention, you talk about excess cash flow. Once you give that lump sum to the insurance company, it's tied up. You really can't just take it all back. No. That's the exchange. You give them a lump sum, it goes in the annuity, and then they'll give you those level payments usually for the rest of your life. So it is excess capital. It's meant to be like an investment, not something you just put in and then take back out. So ideal for the conservative investor. We covered a few of the details there on prescribed annuities, how they can create some tax savings, how they can allow you to benefit from income splitting with non-registered assets. So it definitely does have a home as part of a larger tax strategy for some folks. If you have other questions outside of annuities on other topics, let us know. We're always happy to help out, whatever the topic may be. You can see it on the bottom of the screen there, chatwithclintonkevin.com. Simply go to that website, fill in the form. We would love to hear from you. Anything else you want to add, Kevin?
Yeah, at this point, we've done 4 different episodes so far in this original series on saving taxes. Each one has its own unique aspect in what you're going to do. Not everything applies to everyone, but you know what? For the majority of people, one of these strategies is going to help you down the road. And it's important to think about this because most people don't think about it in their retirement. That's the big thing, saving tax in retirement. But I think today you've covered a great job on what the prescribed annuities are. Again, questions for us anytime, anywhere, any place. We're always around. Well, at least we are on video.
Anywhere, anytime, any place. That's a high bar, Kevin. That's a very high bar.
Well, it's better than saying I'm done at noon or something. So I don't want to do that one. So otherwise, I think we've covered a lot of this topic here. I don't have anything else. I think we're good.
I think we're good. We'll see you again very soon in another video. Take care.